Good morning to you in
Hello.
the Western Hemisphere. Good afternoon to those here in Europe, and good evening to those joining us from Asia. We have a very exciting webinar today. I'm sure you've all heard what's been happening in the SaaS world in the last few weeks. We think this is just the tip of the iceberg, so we want to unwrap all of what's happening here in the webinar. And I hope you come with some ideas, takeaways, how to position yourselves for what's coming. And I like with any technological shift, the last few in the software world, definitely the switch from cloud to from on-premise to cloud. There will be winners and losers, and if we manage to help you be among the winners, you or your clients or your friends, acquaintances, then we will be very happy. I'm Marcin Majewski. I'm the founder of Aventis Advisors. I'm here with Filip. Filip, say a few words about yourself.
I'm Filip, working as a director at Aventis Advisors, doing deals and also monitoring SaaS industry for quite some time. It's been very interesting, all the changes that are happening. We started this webinar series, I think, around a year ago, and we were discussing Trump tariffs and all this situation, and now it's completely different, and the narrative is different, and the situation is different. So excited to be talking about SaaS today.
Yes, yes, yes. So much has changed the last few months.
Yeah,
So I think we're complete. So we can get going. We can jump straight into it. So the title of today's webinar is SaaS Valuations in 2026, AI Disruption and M&A Outlook. We can walk you through what we will cover today. So we'll go through the trends, how we got here, and what we can expect in 2026. We'll talk about whether valuations will recover or not. Then a little bit about M&A in trends in the SaaS space. And lastly, we will talk about different strategies and whether you should exit a SaaS business or whether it's good to pivot, reinvent yourself, or maybe run it for cash flow. We have a question already. Thank you, David. Yes, we will share the recording. We will distribute it to everyone. It will be hosted on YouTube. You can also subscribe to our channel and you can see everything that we post there, including archival, uh, our archival webinars. Anyway, so okay, so let's go to SaaS valuations. Here we have a chart since 2015 with one line is missing, SaaS index. No, here, okay, sorry. No AI index. Uh, anyway, we have more charts, so uh, I wanted to clarify where we're at. Anyway, so since 2015, we've been on a roller coaster ride. Uh, Started slowly with some hiccups in 2019 and then COVID. Then there was a SaaS craze during COVID, uh, which ended quite abruptly as the time of zero interest rates ended. And then mm, there was a gradual recovery since 2023. And it would have looked like it's a continuation of the trend that started in 2015 until not that long ago when it all started to tumble down. And against a backdrop on Nasdaq that is holding quite firmly. I mean, it's not doing great the last few weeks, but it hasn't seen such a dramatic fall like SaaS. So what SaaS used to be the darling of Wall Street, and it seems it's not. And then we ask ourselves what happened. And our take, uh, honestly, is that it never should have gone so high. And we've been always looking at these valuations with a lot of anxiety and doubt because a lot of unprofitable companies have been in slow growth have been quoted at quite high, like 10, 15 times, or I don't know, at some point even 100 times revenue multiples, without clear path to profitability that would justify these valuations. So what we are seeing now is more of a market correction, which is going back to the fundamentals. We don't think it's very dramatic. Uh, it's been long overdue, and it was looking for a trigger, and I think that trigger just happened in the form of all kinds of coding agents that essentially hold the promise to replace parts of the software ecosystem. Whether that is true or not, that's a separate discussion. But in any case, if the valuations weren't excessive in the first place, this would never have happened, because if a technology is robust and makes money here and now, a new technology that might replace it is not gonna have such a dramatic impact on valuations. But these companies were never, or most of them, were not profitable enough in the first place to begin with, which led to this correction. So that's the backdrop, historical. If we look at more closely what's been happening, there is a clear switch in sentiments. AI and SaaS used to move in tandem in NASDAQ, but around May last year, we've seen disentanglement of these two segments. And this is the black line is our AI supply chain index, and the purple line is an index of 194 SaaS companies. So at first it was gradual, but then the bifurcation started to be bigger and bigger, and I think it's gonna continue for the next few quarters, the correction in the SaaS universe. Filip, anything to add on this one? Of course.
Before that, yeah, I think it's really kind of was moving in tandem before that, and now investors are thinking of those two categories as competing really, while before that they were thinking about those as adjacent, yeah, or like AI hype and AI boom also benefits SaaS. Now everyone's thinking otherwise. And kind of one more explanation that I like about why this declines so much is this: companies are unprofitable now, so to justify the valuation, you place a lot of value into what's called terminal value in valuation, so value of the company in 5 or 10 years. And now with AI, everyone's asking like, but what is the terminal value of a SaaS company? Will it be around in 5 to 10
Yeah.
years? So for even a massive company like Adobe, you're thinking Photoshop is absolutely dominating the space. But will there be Photoshop in 10 years? Will it be needed? Like, you can imagine a future where it's not. And maybe Adobe will come up with a tool to replace it, or maybe not, but that risk is there, and that's influencing the value a lot.
Yes. Yeah, so our traditional discussion whether we're now bullish or bearish on the SaaS sector, I would make the case today for a bull case for the sector. Looking at the whole technology supply chain, I think there's still room for companies, SaaS companies, software vendors, to be the middleman between the customer, the user, and the platforms that facilitate coding, essentially. Why would everyone build their own software with AI, which is expensive and constrained in terms of compute and energy output, when you can still have, in this new paradigm, software companies that do it for you and then sell the output, which is somewhat standardized, maybe not bespoke like what Claude can do for you, but still, more cost efficient. And I think SaaS companies will be one of the primary beneficiaries of the AI development, because they will just be more nimble. It will be easier to morph for them, change their product, adapt their products, and enhance and build new functionalities. The only issue, and that's what you raised, you never know which company it will be. So the risk is elevated because there might be a reshuffling, and today's incumbents might not be able to reinvent themselves or might be too slow, like say Kodak, for instance. And we might see them being disrupted by younger companies who manage to build the same functionalities as the incumbents at a lower cost with the use of AI. But I think, there is still a very strong case for someone who would aggregate the development for multiple customers, essentially, and build something much more robust and with much more functionality that's a much lower cost. Whether this is built with AI as a basis or built by humans coding the functionalities, I think this is less relevant. What we will see, though, is that SaaS companies will become much more CapEx heavy and less reliant on labor. So we will see a new, essentially, modus operandi for SaaS companies. And in all cases like this, there's gonna be some turmoil, and that's why it's important to look at these companies through the lens of how they are approaching the upcoming shift in technology and whether they are prepared or not. But I feel very strongly that if you, especially if you can find some gems that embrace AI and are willing to disrupt themselves, essentially, because it often means throwing away what you have right now, the code base you have, and building it from scratch with the modern tech stack. And adapt it to modern workflows. But if you manage to find, invest, or if you have companies like that in your portfolio, or if you operate them, then definitely worth holding on to. And value of such companies, I think, has a chance to explode in line with the whole AI ecosystem. But of course, there are those that will not adapt, like dinosaurs, and that's not gonna be so great for their owners. Your take, Filip.
So I presented the bearish case, and a lot has been said, I think, over the past couple of weeks about SaaS. So I'll just need to choose the arguments which I think are the best to argue for a bearish case. And I'd say one of the biggest one is related to what you said, Marcin, that SaaS companies should have never been valued as high as they have been in the past. And what's super important here is the change in narrative. And all of the SaaS companies were traded at 20 times revenue just because the narrative was there, and technology, COVID, kind of everyone's moving to the cloud and so on. And now, after such a major shift, it's really difficult to come back from this once everyone switched and said, "Oh, we're now believe in AI, yeah, and everything's going to be AI, and SaaS companies are relevant." And the example of this was the newsletter by Citrini Research that they publish and kind of a paper or a hypothesis of what's going to happen, and just moves the market so much. So the market is quite skeptical. And the other one, more fundamental, is just the pressure on revenue and cost. So SaaS companies are now competing with AI for technology dollars. Yeah, so founders and buyers of software are thinking, okay, do I invest in AI? Do I buy credits for OpenAI API? Do I invest in some vibe coded tool, or do I buy this software? And kind of the price comparison is sometimes kind of pushing the prices down for SaaS companies. So there is a pressure on revenue, and the revenue growth has been declining already. But at the same time, to stay relevant, everyone's now needing to invest more in R&D, and some companies that thought that, okay, we've been investing in R&D for the 10 past years, and now it's time to cash in all these investments and get high margins. Turns out that's not the case. Maybe they need to continue to invest more and more. These profits will never come. So my idea is that with bearish case, there is a further space to go down. And really, I wouldn't be surprised if in 1 or 2 years, most of the companies would be traded at EBITDA multiple or price earnings multiple in line with another different businesses which are growing at 10% and generate, I don't know, 15% margin, which are most of the businesses those days. And kind of summing it up, let me enable the poll if you're bullish or bearish on SaaS. We did it last time, so let's see if anything changed. And in the meantime, I think we'll move on to what happened during the year-to-date period from January 1st to now. And that's where the real bifurcation started, with AI growing a lot, plus 26%. AI, meaning AI supply chain. So inside of it, we have all the electricity providers, chip manufacturers, data center operators, all the suppliers of UPS systems, HVAC, and so on and so forth. So those companies have been on a run, supported by the big capex commitment. And while at the same time, as we said, SaaS companies been under pressure. Everyone's thinking they're not relevant anymore. They have to invest a lot of money to stay relevant, or just anyone can vibe code an alternative to a SaaS product. And so the kind of value of all the code base and all the experience accumulated is getting lower. So we took a look also across the SaaS index for best performers and worst performers year to date. So among the worst performance, Atlassian, Monday.com, Asana. So project management tools, so stuff that you can say is a visualization of a crude database. So you have some tasks, people assign timelines, and those products just represent that and shows it via a Gantt chart or to-do list. So something which is simple and people are thinking AI can replicate. And across the best performance, we put it together and saw companies that we didn't know, and then said, okay, so those companies are probably obscure and vertically focused, which is the case. Like Cerillion is a telecom vertical focused SaaS. Some of those are in identity space. So companies which are not so well known, but they're working with some specific use cases, and that's where we see in SaaS can be a bit more stable and relevant, some hard to replace workflow, some accumulated data, accumulated knowledge, vertical specialization, or just really processes which are super important, such as billing and operations for a telecom. And we're going to touch on that a bit later. In the meantime, the people have voted. So I'm finishing the poll, and it's more or less 50-50. I don't know if you're seeing the
Yes,
results here. So
I see.
I don't remember. Wasn't it the same last time?
I think people were much more bullish. I think
Yeah,
3/4, something like that. Yeah.
we need to go back. Yeah, but with 61% turnout and 55% are bullish, 45% are bearish. But then again, last time's evaluations were also much, much higher. So
It's easier to be bullish
it's
now,
easy to be bullish.
paradoxically.
Yeah.
If you look at it without any emotion. Yeah.
All
Mm,
right. So moving on to the SaaS growth rates and kind of where we have as enterprise value to revenue growth ratios. So what I said, we're seeing the continued decline of growth rates that has been happening for the last 3 years, I would say, really since the COVID times, the revenue growth has been declining, and in what the companies are guiding for this year, it's basically will be heading to under 10% territory. Yeah, so that's why we're telling the fundamentals are not that great, and the revenue multiple is not the best way maybe to value those companies is just because the revenue growth is not there anymore. So we're expecting profitability, and we don't show it there, but the profitability was improving over the past year. Kind of the margins, net profit margin, EBITDA margin was improving. So companies are taking this kind of this feedback from the market seriously, and we're seeing some uh, kind of first reactions even to AI with Block laying off 40% of the staff. I think it's you can argue if it's really AI related or the company was just bloated, but kind of it's a fact, and the stock market investors um, kind of rewarded the company with a big jump on that announcement. So I think the margins will continue to grow up. And on the right hand side is enterprise value to revenue growth. So how much EV revenue multiple you're paying for unit of growth that declined a lot from the peaks of last quarter of 25, but still quite high by historical standards. So we're thinking it's there's still room to go down.
yes, this is very interesting because it would seem that from the chart on the left-hand side that compares global SaaS to US, that only the US is affected. It's not quite true. Maybe there's a small decline in valuations, but it's clear that the sentiment has turned against US companies, which no longer trade at a premium. This is something that happened, yes, since we've been watching this in 2015. It's the first time this has ever happened. I think the nature of SaaS companies that operate in other countries is a bit different. I think they're less exposed to AI risks because they cater to local audiences more, mm, and are a bit behind, I guess, AI adoption than the leading markets like US and China. So I would expect there would be an impact on global SaaS companies as well, but so far so good for the rest of the world. Mm, we shall see how this develops. But I mean, this is a major shift in what we've seen. Another major shift. I don't think you in the past you heard much about EV/EBITDA multiple in the context of SaaS because they were growing so fast and redeploying all the earnings into growth. Now that growth is rare, I think it's important to bring back more down to earth metrics. So we took the whole sector and summed up EBITDAs of all the companies in our index to see where we're at. And as a whole, actually, we're at fairly reasonable levels because we're at 26.6. I would expect we go down a little bit from here. But I'd say it's kind of a benchmark for old school companies from the traditional economy. So that's also a very interesting development. That essentially the sector trades now like traditional industries. So really big shifts here. America no longer trades at a premium, and EBITDA multiples are reasonable. It's quite an interesting development. So a little bit of what's going on, and we repeat the message we had in our previous webinar in October 2025. There's a clear sentiment shift to AI companies, and this is evidenced by how much funding they managed to raise in the last year, which was through the roof, 211 billion in 2025 alone. And what we were anticipating, and I think this is happening right now, is that gradually SaaS companies are being replaced with AI agents. And we're hearing more and more stories that people take OpenClaw, I think the hottest new piece of technology, and they're building replacements for large products like SAP Business One, for instance, or Monday, which is for sure chipping at the edges of these large businesses and vendors. But it's really hard to say how fast this can go. There are a lot of tools that you can use to vibe code whatever you want, and still, I mean, barriers to entry are big because we try to do it ourselves. We're in the early innings of our journey through this. But it's definitely gonna happen. But at the same time, if I had a vendor, software vendor that would do it for me, I'm sure I would prefer to pay them than do it myself. So our hypothesis is that a lot of the companies will follow what Palantir does for their clients with forward deployed engineers who build solutions for their customers rather than building on the off-the-shelf packages and just selling them as is to customers, maybe with some customization to partners. So we'll see how it goes. I think a lot depends on the decisions that companies make, how they will adapt to the changing environment. But definitely something to watch out for.
Yeah, so I think it's a lot of testing on the edges and testing the assumptions underlying those big companies. Like if before we thought SAP is immovable, it's not gonna go away. It's there for 20, 50 years. So now the question, is it so immovable and kind of on the longer time horizon? Because when ChatGPT rolled out, it was also writing some texts, but quite poorly. And then people said, oh, it's kind of not so good. And now I don't know if there is any kind of text written on the internet without the use of AI.
Yes. So true.
Yeah, so here we kind of also came back to the mindset of acquirers in AI era for SaaS companies and kind of what was important usually for SaaS companies and what we're seeing now. And actually in our transactions, we're seeing more and more buyers are asking, okay, so how are you addressing AI disruption potential? And more deals are getting disqualified because of AI, and I think it's a big risk to valuations. So yeah, there is like kind of AI era questions to each of the factors which were important during SaaS era. So business model, can the business model be changed and scaled pricing with value delivered, not user sold? There's a lot of talk that user-based pricing or seat-based pricing will go away. Just first because there will going to be less seats per customer because AI is going to disrupt a lot of the jobs, but also people don't want to pay anymore just for the users or for the seats. They want to pay for outcomes. And we're seeing it also ourselves with using APIs, for example. In our AI, it's very transparent that you just pay for the outcome. Yeah, the same for the business size. You know, there are a lot of questions. Can a startup be founded real quick and, you know, replace your current business? So, you know, everything which is rather simple and easy to replicate using vibe coding, Lovable, GitHub Copilot, and so on. This is now a kind of big downside to any SaaS company. Churn, you know, the churn has been one of the most easily predictable factor in the past just because it was stable. So now you cannot make this assumption going forward anymore because a new product may appear or the churn will increase because just another solution will start paying off more for a customer. And same with customer acquisition costs. A lot of companies are suffering now because of changes in Google algorithm because of AI overview. So the traffic gets diverted and it's not that easy to find customers anymore. You need to invest into AI optimization so that AI recommends your product and can new customer acquisition strategy. So in any area of kind of analysis for SaaS companies now, there is a bit of a new AI angle, and all the buyers are thinking, okay, how AI is affecting this or that for this company. And there's a new lens in 2026 is what we're thinking is, are the customers, your customers' industries themselves being disrupted by AI? So if you're having a SaaS which has a seat-based pricing, so what's going to happen with the business if suddenly the number of seats will go down? So a lot of SaaS companies were growing so well because they had positive net revenue retention. So they were able to grow with the business and kind of have more and more seats in a given company. So now the trend seems to be that they're going to have fewer seats with a client because of optimization and kind of cutting the staff. So that's just a risk which is inherent in the business model. So we were thinking how to analyze how SaaS is exposed to AI disruption, and we liked a lot the framework which was introduced by SaaS Capital. They basically analyze any company on 3 dimensions in terms of its potential disruptability by AI. And so if you have SaaS businesses in your portfolio or you own SaaS business, you can apply that to yourself and think how disruptable is your business. So those 3 dimensions are, first is system of record. So does your product own the ground truth of a business process, meaning is the data which is super important for any business stored in the product? So one point if it's not a system of record and the data lives elsewhere. So you can think, for example, of email marketing tools where the data is actually in the email and emails are being sent just through a platform and there is only an analytics layer, but no ground data stored there. Well, 4 points is something like a mission critical system of record. So if you're in the commerce business and you have a system where your inventory data, pricing data is stored, and if this system doesn't work, then just your whole operation stops because you don't get the deliveries, you don't send product to the customers, like you cannot call the price on the website. So something which will just stop your operations. So a SaaS like that would get 4 points. And the other thing that they analyzed is a non-software component. Like, is there anything else besides software in a SaaS company? And I think before AI, people preferred a lot pure SaaS revenue, subscription revenue. It was the best, and all the hardware services revenue was discounted a lot because it was not subscription, lower margin, so on and so forth. So now people are thinking, okay, but what if that is actually a competitive advantage for your business? Access to some proprietary data as opposed to pure software. So kind of 1 point here in maximum disruptability. If the product is just software, there's some inputs, processes, and outputs, and there's no value added. While 4 points is some unique and high value data that is also used in the product. So, for example, all the software that are using data available from the web, like, I don't know, phone numbers, emails, scraping some data. This is still a 1, but something which is really proprietary, like a telecom data or, I don't know, bond pricing data for a Bloomberg terminal that is not available anywhere else, then you can get a 4 points on that. And then the final is user and usages. The question is how senior is the user and how large decisions they're making. So if it's a very low stakes product like individual contributor level, just kind of people on the front lines are using it and you can swap it really fast and no major decisions are affected with that product, then it's a 1. And 4 points is basically a software product where the C-level people, CEO, CFO, CMO are logging in daily and checking something and kind of deciding on a $1 million budgets. Okay, we direct it here, we direct it there. So that's going to be 4 points, and the type of usage where the bad the company decisions are. So, and the framework is to sum it all up, analyze your software product, your SaaS business really critically, and think how disruptable it is or not with AI. And kind of anything where the average is below 2, I think it's quite a high risk, and everything where the average is above 3, it's more or less protected or has a significantly longer shelf life. So what's next? How to position in this AI first world, Marcin?
Yes, this is a question that I think everyone is asking themselves if they're taking their investments, finances, and careers seriously. We try to contribute a little bit to this discussion, but I'm sure everyone has their own thoughts about it. Anyway, we have a small decision tree here. If your product is structurally exposed to AI, that's not great. Then we see 2, let's say, easiest strategies without disrupting the business, turning it around. I think while still valuations are sensible for software businesses, and the AI threat is still uncertain, hasn't quite materialized. So right now it's a risk, not necessarily a problem. we still believe that valuations are good for sellers. We still believe that capital dry powder raised in the heydays of SaaS is still plenty, and it's worth to explore an exit and transfer the risk to someone who has more resources, can maybe the risk across several SaaS companies, or will merge the business into something bigger and make it then maybe more secure, more resilient. Or, and this is something we advise to consider seriously, is just to optimize the companies for cash flow rather than trying to take the wave that is coming head on by cutting R&D and sales and marketing expenses. We've seen companies do this, embracing at the same time AI as a development tool. And I think for many companies it's viable. It's more advantageous to this than fight in a world where they cannot win. Mm, so these are the options for those who are at the highest levels of risk. If you feel like you want to and you can embed AI into your product, so if you're mission critical, you tick a few of the boxes Filip mentioned before. If you're vertically specialized, if you can add AI features to your product that will make a meaningful change, then I think this will be one of the greatest times for such companies, and it can take some of these businesses to unexpected levels of success. I think everyone is asking themselves how to adapt to it and scale, which is our option C. But definitely for those who are bold, who are driven, we see great chances of success. We've seen companies from small SaaS businesses to Google going into founder mode. I think this is mandatory here because for many companies, a founder persona or a similar level of sponsorship of this initiative is the way to go because of the extent of change. And there will always be resistance, and you will always step on people's toes when you're trying to effectuate a change like this. But we feel very strongly there is a great opportunity. It's a generational opportunity, but we also know it's going to be hard, expensive, and there will be a lot of risk associated. And I don't know, Filip, if you have something to add.
Yeah, I think all are viable options, all are very difficult options. I think from exploring exit, which is kind of saying goodbye to your business or transitional to a different role, milking for cash flow also comes with some reductions in headcount, basically, which is the most significant cost for SaaS companies, while adapting and scaling is getting back to square one and assuming that what you've built so far doesn't matter anymore and you need to kind of start designing something from scratch. And as you said, stepping on someone's toes or changing an organization or kind of assuming all your past revenue is obsolete, or up for disruption. So you need to come up with something new. So all very difficult situation, but with their risks and returns, I think all in all options A, B, and C, there is a big potential for financial return to anyone who
Yes.
approaches that. Yeah, option B can be, I don't know, could be more profitable than option C because option C comes with a lot of risks, and it's
You
a.
never know, yeah, where you end up.
So we have some time for questions. If there are any questions, would be happy
Yes,
to answer.
we have only one. We received one about the profitability of AI comps. I mean, profitability of our AI comps was through the roof because it's mainly manufacturing or utilities companies. So yes, it's high. Mm, but if there are no further questions, then I think we can wrap it up for today. Mm, happy to meet you offline or take any questions by email if you'd like. Thank you for your time. Oh, we have one last minute question we can ask. Do we think companies with more regulation are less impacted, compliance, etc.? Yes. And there are companies that are in highly regulated industries, like I know energy, utilities, military, mm, compliance, banking, finance. Yes, they're less exposed for sure. The replacement cycle is very long there, so
Yeah,
they have much more time to adapt.
in this AI disruptability framework, basically, they're gonna get a lot of points for system of record just because of regulations. You're gonna need software where all this
Yeah,
data is stored for legal and regulatory purposes. So it's a banking software which or processes transactions and needs to have it bulletproof, 100% correct, no 90%
yeah.
AI correctness, which is like kind of right. Then yeah, of course it's gonna be more difficult to disrupt.
Yes. Another question. Have we seen any uptick in customer attrition as a result of AI? Mm, it's hard to attribute attrition directly to AI. I
I
think indirectly, probably for multiple reasons. One is that attention has shifted, no, to so
I
uh,
think maybe not so much on attrition, but on new ads. Yeah, more effect on new ads and customers negotiating tougher on price, and customers consider,
definitely.
okay, can we do it ourselves, and kind of calculating the value of investment in software. Yeah.
Yes, yes. The slides are will be available. Another question, how would we cope with the shifted mindset in sales size? Do more tech DD? I mean, we're seeing that tech DD will be a bit different, is changing. And I mean, and also the commercial part is changing. So definitely, I mean, also because a lot of slop probably will be coming to market. I mean, uh, companies that have been built haphazardly in a very short time, vibe coded, they are reasonably successful. But then, if you look under the hood, it's code that is very hard to maintain. My friend calls it spaghetti code. Uh, and uh, and I think yes, buyers will pay more attention to this. Mm. Oh, a lot of questions. I'm very happy. How do you rate proprietary professional services as part of the non-software components? That's a great question because all until not long ago, professional services have been an afterthought, necessary evil for companies to do to maintain their customers. But I think now they might be the main point why that's preventing churn. Because if you're happy with the support you're getting, if you can, if the software can adapt to your needs thanks to some extra services, then I think it's gonna be a big boost to revenue and to long-term sustainability of that revenue.
Yeah, I'd say it's more like 2 points on that scale. So it's not really a very big differentiator, such as some kind of proprietary data, but it's definitely better than just some software which you put stuff in and gives you output, and no integration implementation involved.
Yeah. Okay, another one. Is SaaS with thousands of users less exposed than with a few? I mean, a SaaS with thousands of users still can be large accounts. I mean, the size of the accounts, of the deals, how mission critical they are, I think is a bigger indication of how important the business is. I can imagine a business with 5 customers being super safe from any SaaS risk because I know if it's like social security institution, a telco incumbent and something and doing something compliance related, for instance. That's not a big deal, not a big risk. But a MarTech SaaS that has to compete with 1,000 similar companies, they're very exposed. Okay, another question. What's your outlook on M&A and SaaS this year and IPOs? IPOs, I think, will be very few
Yeah.
because the valuations fell. But M&A, I think it's going to be a great year for M&A because of the risk. Obviously, I mean, if the private equity exits, we see a lot failing on the larger side of the market, the large caps. But I think small caps, there's going to be a lot of change of ownership because I I think a lot of founders don't want to live with the AI disruption risk. So I think it's better for them to pack their bags, sell it to someone who can handle it and who's more diversified. Because if it's, I mean, if a business is 90% of your net worth, that's uncomfortable to live through this change. But if you have 20 SaaS businesses, you can, I think, manage it a bit better and de-risk them. So I think there's gonna be much more activity this year. Last year was also quite good. Filip, you take the next one?
AI, what's the impact of AI on the multiples for on-premise software companies? I mean, I'd say the transition from on-premise will continue. Just maybe now there will be some kind of jump from on-premise to AI native companies, which would be fun to see. It's like in some countries 20 years ago missed all the PC era and jumped right to mobile. Maybe we would see the same here. But unfortunately, I think on-premise is still going to be declining. So they're going to be a lower multiples than for SaaS companies.
My take is a bit different. I think on-premise is more resilient, paradoxically, than cloud software. I think it's more difficult to replace. Obviously, there was this interesting discussion or hype around COBOL being replaced because Claude can now code in COBOL. But I think, I mean, mainframe systems, they're still doing fine. No one's touching them if they don't have to. So I'd say, I mean, less of an impact than for other types of software. They have other risks, of course, mainly the cloud replacement. But I think you have to go first to cloud before you consider going with AI agents. And a point from Ernest, which I totally buy, will AI not actually boost SaaS? use cases that were too difficult to solve and unprofitable to solve using normal coding can now be solved using AI and SaaS Pro. Yeah, I totally buy it. I think this will be a big enabler, and if SaaS companies can reposition, reinvent themselves to be partners for their clients to solve their problems that have been unaddressed, impossible to address, then I think it's gonna be a big win for these companies. Awesome. I think that's it. Thank you all for your questions. Thank you for staying so long with us. We will share the slides and the recording, and we encourage you to get in touch and speak to us directly if you're considering any type of M&A deals in this space. Thank you very much.
Thank you. Bye
Thanks.
bye.